Welcome back to Investing Talk Podcast.
Great to be here.
Today, we're taking an in-depth look at a company that, well, it definitely sparks a lot of conversation in the digital advertising space. The Trade Desk.
Oh, yeah, absolutely. Lots to talk about there.
And we're tackling the big question, the one everyone asks. Is the Trade Desk a good time to buy right now?
The million-dollar question, as always.
Exactly. Now, we've gone through a whole stack of sources for you. Recent earnings reports, financial health checks, market data, expert analysis, the works.
Covered the bases.
Our goal here is just to cut through some of the noise and give you a clear, informed perspective on what's going on.
Makes sense.
And hey, if you find this conversation helpful, please do remember to subscribe, like, and maybe leave a comment.
Yeah, always helps.
And definitely, if there's a specific company you'd like us to examine in the future, just let us know in those comments below.
Good idea. What's fascinating here, I think, when you look at a company like the Trade Desk, is that, there isn't just one simple answer.
Right.
It's more like a tapestry, really. You've got operational strengths, market signals, future potential. It's all interwoven. So to really get a handle on its true position, we kind of need to pull on a lot of different threads.
Absolutely, and that's exactly what we're going to do. Let's start with the foundation, The Trade Desk's fundamental health, nuts and bolts of their business.
Okay.
When we dive into their recent financials, what's the first thing that jumps out?
Well, the headline numbers, they're certainly compelling. The Trade Desk really showed some muscle in the first half of 2025.
Yeah.
Pulled in $1.31 billion in revenue. That's a 22% jump year over year.
22%.
Yeah, and Q2 alone contributed $694 million of that. Still a solid 19% increase from the year before.
Okay.
So what this tells us is, even in this really dynamic digital ad market, they're not just growing, they seem to be accelerating in some key areas.
And it's not just about the top line, right? That revenue.
Yeah.
How does that actually translate down to profitability?
Precisely. That's the key question. Beyond revenue, their operating income for Q2 2025 hit $116.8 million.
Okay.
Which means a pretty healthy 17% operating margin.
17%, not bad.
And critically, that margin itself was up 23% year over year.
Yeah.
So better profitability on the higher revenue.
Got it.
Net income followed that trend, landing at $90.1 million, pushed diluted earnings per share, or EPS, to $0.18.
Okay, $0.18. Wasn't it 17 cents before?
It was 17 cents the prior year. So a slight bump up, but an important one.
Right.
These figures, they kind of suggest that the growth isn't just, empty calories. It's translating into real increasing profitability.
That's a strong picture on the income side, definitely. But what about the costs, the expenses behind that growth? I did notice operating expenses saw a pretty significant jump, too.
They did. Yeah, you're right to point that out. Operating expenses grew 18% year over year in Q2, came in at $577 million. Now, a big chunk of that, a 37% surge actually, was in platform hosting costs.
Okay, hosting. Why so much?
Well, this isn't necessarily a bad sign on its own. It's mostly driven by just higher impression volumes, more ads being served, and, crucially, building out new data centers.
Infrastructure investment.
Exactly. It's kind of the cost of scaling a big global platform like theirs.
Makes sense.
However, you also have to look at stock-based compensation. That remained pretty notable at $129 million. Just for the quarter.
Ooh, yeah, $129 million.
Now, the CEO's specific option expense declined, but this is still an area investors, they often scrutinize for potential dilution down the line.
Right. We've got to watch the share count. Okay, so they're investing heavily in infrastructure to support that growth. How robust is their overall financial health? Can they sustain this kind of investment?
This is actually where the Trade Desk really shines, I think.
Oh, yeah.
As of the end of June 2025, they had $896 million in cash and equivalents on hand.
Okay, almost $900 million.
Now, you might notice that's down from about $1.37 billion at the end of 2024.
Yeah, that's a drop.
But there's important context. A huge chunk of that decrease, $657 million, was actually used for share repurchases recently.
Buybacks, okay.
So they're actively returning capital to shareholders, not just, burning through cash on operations. They also held another $791 million in short-term investments.
And the balance sheet itself, particularly their debt situation. I heard something about that.
Absolutely. This is what truly sets them apart, I feel, especially in a capital-intensive sector like ad tech. They are completely debt-free.
No debt at all.
Zero debt.
Yeah.
That gives them tremendous flexibility. Plus, they have $443 million still undrawn on a $450 million revolving credit facility.
So like a big emergency fund they haven't even touched.
Exactly. Think of it as a huge safety net they don't currently need. And their operating cash flow,
Yeah.
exceptionally strong.
How strong?
Generated $456 million year to date. That's up a really robust 71% year over year.
71%? Wow.
Yeah. And even after investing $104 million in capital expenditures, those data centers and things, their free cash flow remain solidly positive. It paints a picture of a very resilient, self-sustaining kind of business.
Okay, that's reassuring on the health front. Moving beyond the pure numbers then, where does the trade desk actually stand competitively? I mean, digital advertising is a really crowded space.
It is. But they've carved out a very strong niche for themselves. The trade desk is basically a leading independent demand-side platform, or DSP.
Right, DSP, independent being the key word.
I think so. Their strength isn't just the tech itself, though it's good. It's their scale, their heavy investment in data, and especially their strategic partnerships.
Partnerships like
Particularly in those high-growth areas we keep hearing about, like connected TV, CTV, and retail media.
buy. Yes.
This strategy isn't just, supporting current growth. It feels like it's future-proofing their revenue streams in a market that's changing really fast.
So what makes their approach different, maybe unique, compared to some of the, the giants in the space? Google, Amazon.
Well, their platform-agnostic approach is a really key differentiator.
Agnostic meaning?
Meaning, unlike some big competitors that might prioritize their own media properties, steer ad buys towards their own stuff, the trade desk works across the whole open internet.
Okay, so more choice for the advertiser.
Exactly. It offers advertisers what they often call true independence and transparency. That, plus a really high U.S. revenue mix, about 86% of their gross billings come from the U.S.
86%, wow. Mostly domestic.
Yeah, which actually helps them navigate some of the international market volatility and maybe some of those privacy headwinds you see cropping up, especially in Europe.
Right.
So yeah, they compete head-to-head with giants like Google's DV360 and Amazon. But that independence and transparency, often cited by clients as critical advantages.
Okay, so we've established a pretty solid fundamental picture here. Strong growth, healthy finances, clear competitive angle.
Seems that way, yes.
Now let's switch gears a bit. Let's turn our attention to what the market has been saying. The recent price action, technical indicators. What story is the market telling us right now about the trade desk?
All right, the other side of the coin. Well, looking at that recent period, say August through early September 2025, the stock's been trading in a relatively tight range, specifically between about $51.60 and $55.30. That's based on the Nasdaq Q closing prices as of September 8th.
51 to 55, roughly. So kind of consolidating.
Yeah, exactly. It suggests a period of consolidation where the market is maybe trying to find its footing after some bigger moves earlier.
And for our listeners who, track the charts, what are the key support and resistance levels we should be watching? Where might it bounce, or where might it hit a ceiling?
Good question. From a technical perspective, we see some notable support down in the $48 to $50 range.
48 to 50, okay.
That's often seen as a kind of floor, where buyers tend to step in more actively.
Got it. And on the upside, resistance.
Resistance seems to be encountered more in the $56 to $58 range.
56 to 58.
That indicates where selling pressure tends to pick up. So yeah, those are sort of the critical lines in the sand right now for understanding potential short-term moves.
And those moving averages, the 50-day, the 200-day simple moving averages, SMA, what do they tell us about the current trend, the momentum?
Right. So the 50-day SMA is currently hovering around $53.
Okay. Inside that recent range.
Exactly.
Yeah.
While the longer-term 200-day SMA, that's sitting up near $59.
Ah, so the short term is below the long term.
Correct. And that configuration generally indicates a short-term downtrend is technically in place.
Okay.
However, there's potential for what's called mean reversion, basically, a bounce back towards the average, especially if the price can firmly hold above that $50 support level we mentioned.
So downtrend now, but maybe potential to recover if $50 holds.
That's the technical picture, yeah. It's like a car that's dipped below the speed limit but still has the engine power to get back up to speed, potentially.
Okay. What about other momentum indicators like RSI, MAD? Are they flashing any strong buy or sell signals?
Not really strong signals right now. The Daily Relative Strength Index, the RSI, it's been kind of oscillating between 46 and 54.
Pretty neutral then.
Exactly. It suggests neutral momentum. It's not signaling an oversold condition, which might hint at a rebound, nor is it overbought, which might suggest a pullback is due.
Okay.
And the MACD indicator, it shows maybe a slight negative divergence, but again, nothing screaming buy or sell right now.
And volatility, has it been jumpy?
It was elevated right after their last earnings report, which is
Right.
pretty typical.
Sure.
But it has since normalized, suggesting maybe less erratic price swings for the time being.
Okay, so the technical picture is a bit, well, mixed maybe. A
Yeah.
short-term downtrend, but without really extreme momentum, kind of waiting for a signal.
That's a good way to put it, yeah.
What about the news flow then? And
Huh.
analyst sentiment? How does that layer on top?
Well, interestingly, despite some of that technical caution, their Q2 2025 results, the revenue and profit actually topped the consensus estimates.
Oh, they beat estimates. I thought there was some issue there. We'll get to that maybe.
Well, revenue and profit beat, driven largely by that strong demand in CTV and retail media. So it validated their strategic focus areas.
Okay.
And they've also been quite aggressive with share repurchases. Remember, buying back $657 million year to date.
Right, the buybacks.
And they still have another $375 million authorized. That's a significant move that can support the share price. And, it signals management's confidence, typically.
And the analysts,
Yeah.
folks on Wall Street who cover the stock, what are they saying about the trade desk right now?
The most recent consensus among analysts remains largely overweight or buy.
Okay, so generally positive.
Generally positive, yeah.
Heck yeah.
That's a good sign of underlying confidence in the company itself. However,
There's always a however.
there often is. Some analysts have trimmed their price targets after the latest earnings,
Why?
citing concerns around valuation, is the stock too expensive, and also that growth in expenses we talked about earlier, the hosting costs and SBC.
Yeah.
So it's a nuanced view. They seem to like the company, but perhaps they're being a bit more cautious on the price they think it's worth right now.
Okay. And no major M&A or big disruptive news lately?
No, nothing really significant on that front recently. No big mergers or acquisitions or anything truly game-changing in the news flow.
Insider activity can sometimes be a bit of a tell. I understand there were some sales, but there's context. Can you shed some light on those recent insider sales?
Absolutely. That's important context. We did see several insider sales between Q2 and Q3 2025, including from the CEO, Jeffrey Green.
Okay.
However, and this is crucial for investors to understand, these were done under what's called a 10b5-1 plan.
Right, the pre-scheduled plans.
Exactly. It's essentially a prearranged stock trading plan that insiders set up when they don't possess material, non-public information.
So they plan these sales way in advance.
That's the idea. It's like setting an automated trade for 6 months down the line. So while, yes, it's still a sale, it strongly suggests it wasn't a knee-jerk reaction to some new negative insight about the company.
Makes sense. Does the CEO still hold a lot of shares?
He does.
Mm-hmm.
Even after those recent transactions, he still beneficially owns a substantial number, 218,246 shares, directly. So his skin in the game remains pretty significant.
Okay, that context is really helpful. So what this all paints for me is kind of a fascinating dichotomy, isn't it?
How so?
Well, you've got these strong company fundamentals we discussed first.
Right, the debt-free balance sheet, the growth.
But then the technical indicators are showing this short-term downtrend and maybe mixed sentiment, especially among retail investors.
That's a perfect summary. Yeah. The market seems to be really digesting a lot of information right now and trying to find its footing.
Mm-hmm.
Social sentiment, looking online, it seems largely positive among the big institutional holders. They
Okay.
tend to focus more on the long-term fundamentals.
Right.
But among retail investors, sentiment seems more mixed, often driven by those perceived valuation concerns. Is it too expensive? And just the recent price volatility.
Yeah, that makes sense.
This kind of dynamic, it's pretty common when you have a fundamentally strong company that hits some short-term headwinds or questions. Leads to a period of uncertainty.
Okay, so we've looked at the past, the fundamentals, the present market signals. What does this all mean looking ahead? Let's examine maybe the recent past that set the stage and then the upcoming events that could shape the trade desk's path forward. And the risks, of course.
Right.
The last 3 months, they've certainly been a bit bumpy, haven't they? Providing critical context for how people feel right now. Can you walk us through the significant events there?
Yeah, the last 3 months were definitely challenging for the stock. Back in July 2025, you saw competitive pressures really intensify,
From who?
particularly with Amazon expanding its presence in retail media and CTV advertising. That seemed to lead to some negative investor perception.
Okay.
The trade desk shares dropped a bit then, responding to concerns about maybe slower growth ahead and, again, those stretched valuations.
And then came August, earnings time.
Exactly. August 7th. The trade desk reported their Q2 results. Now, Remember we said they beat revenue forecasts?
Yeah.
Well, they missed the consensus EPS estimates, and significantly.
Ah, that's the catch. How big a miss?
The actual EPS was 18 cents, but the expectation was $0.42.
Ouch. Less than half.
Yeah, it was a substantial miss, almost half of what analysts were anticipating. It kind of signaled that maybe profitability wasn't scaling with revenue quite as efficiently as the market hoped, despite that top-line growth.
Okay, that explains the market reaction then.
Absolutely. And the conservative forward guidance that they gave alongside those results, that triggered even more selling. The share price tumbled over 40% in the aftermath.
40%? Wow.
Yeah, a huge drop. And trading volume plummeted too, like 67% below average right after earnings. That clearly signaled some hesitation from the big institutional players.
That's a dramatic response, and it sounds like that weakness kind of lingered into September.
It did, yeah. The stock continued to decline slightly into September, even while, interestingly, most analysts stuck with a buy rating overall.
So they still liked it long term, but...
But they acknowledged the long-term potential while noting those ongoing valuation concerns and the short-term headwinds from the EPS miss and guidance. So yeah, a really tough period where the market definitely punished the stock.
Okay, with that recent rough patch in mind, what upcoming catalysts should investors be watching for? Say, in the next 3 months or so, that could potentially shift sentiment one way or the other.
Right. Looking forward, there are several key dates and events to keep an eye on.
Like what?
October 1st, 2025. You have potential ETF rebalancing. That can sometimes influence trading flows just based on index inclusion.
Okay, technical flows.
The mid-month, October 15th, we should get the holiday ad spend outlook. That's a crucial macro and industry indicator. Tells you about broader trends in ad spending.
Very important for them.
Definitely. November 1st, you might see filings showing institutional fund purchases from the previous quarter, which impacts the ownership picture.
Uh-huh.
But the really big one, undoubtedly, will be the Q3 2025 earnings release. That's scheduled for November 6th.
November 6th. Mark the calendars.
Exactly. That's likely to dominate volatility and really set the tone for the stock heading into year-end.
And after earnings.
Later in November, around the 20th, we'll probably see the Q4 initial holiday report. Gives more industry-wide insight into how that crucial holiday spending season is shaping up.
Okay, so lots to watch on the calendar. Beyond those scheduled events, though, there are always, rumors, speculations swirling around a company like this. What are some of the whispers or potential speculative catalysts out there?
Yeah, there's always chatter. One persistent theme is potential buyout interest from major tech firms.
Buyout. Really?
Well, you see broader consolidation happening in ad tech, and the trade desk's independent position could make it an attractive target for someone looking to bolster their ad offerings. It's speculative, but it's out there.
Interesting. What else?
We also hear rumors about potential new CTV partnerships, deals that could maybe strengthen their competitive edge against players like Amazon and Roku in that key battleground.
Okay.
Management has also kind of hinted at increased investment in AI solutions for ad planning and buying.
Yeah.
So that fuels speculation about, significant AI-powered platform expansion coming.
AI is everywhere.
It is. And one more technical point. With unusually high short interest on the stock sometimes.
People betting against it.
Right. There's always the background risk or potential catalyst, depending on your view, of a short squeeze if some positive sector news hits unexpectedly. That could drive the stock price up sharply, even if temporarily.
Right. Forcing the shorts to cover. Okay. So with those significant pressures from the last 3 months still maybe fresh in mind and these upcoming catalysts, how do you see the trade desk navigating these forces? That Q3 earnings report in November sounds absolutely critical for sentiment, doesn't it?
It really does. It feels like it will set the stage for how investors perceive the company's ability to rebound from that Q2 miss. Investors will be laser-focused, scrutinizing growth rates, margins, looking for signs of recovery, and seeing how those big investments in infrastructure are actually translating back into renewed profitability growth.
Let's talk about the potential pitfalls, though, the flip side. What are the key risk factors investors really need to keep front and center, both specific to the trade desk and maybe the broader market?
Good point. Always need to consider the risks. On the company-specific front, there's ongoing litigation.
Litigation about what?
Various things. Securities, filings, privacy issues, governance cases. These always carry potential legal and financial risk, even if they seem minor initially.
Okay.
That high stock-based compensation we mentioned, the $129 million per recent quarter, that is dilutive to existing shareholders over time, and it's something that needs to be monitored closely. How much is going out the door in shares?
Right. Dilution risk.
And while those aggressive share buybacks can signal confidence, some might also interpret them, potentially, as signaling maybe limited organic growth opportunities ahead, or maybe even risks in capital allocation discipline if they're overpaying or not managing it carefully.
Interesting angle on buybacks. Okay, and what about the bigger picture? The market, the digital advertising sector itself, what are the overarching risks there?
Well, on a brighter level, you absolutely have to remember that digital advertising is inherently cyclical,
Meaning?
meaning it's highly sensitive to global economic conditions. If there's a recession or even a significant slowdown, ad spending is often one of the first things businesses cut back on.
True.
Then there's the intense competition. It's a constant factor. Large tech platforms like Google and Amazon have huge advantages and could limit the trade desk's growth potential or pressure their margins.
The giants are always there.
Always. And finally, regulatory and privacy changes. This is a big one. Whether it's new rules in the US or the EU, things like changes to cookie policies or data usage, these could significantly impact revenue streams or require really costly system overhauls to comply. That's a persistent cloud over the whole sector.
Okay, this has been a really comprehensive look, covering a lot of ground on the trade desk.
Try to hit the key points.
So the big question we started with, what does all this mean for you, the investor, looking at the company right now? Let's try and bring it all together with an overall assessment. After weighing everything, where do we land on, say, an overall rating?
Okay, yeah, pulling it all together. Considering all those factors we discussed, the strengths, the challenges, the market signals, we're giving the trade desk an overall rating of, let's say, 7 out of 10 for its current investment profile.
A 7 out of 10. Okay, solid, but not perfect. Can you walk us through the rationale behind that score? What makes it a 7? What keeps it from being higher, or maybe stops it from being lower?
Sure. The core of that 7 rating really lies in its strong fundamental growth profile.
Right, the stuff we started with.
Exactly. We're seeing consistent double-digit revenue growth. Profit increases are generally there. That fantastic debt-free balance sheet, excellent cash generation.
Yeah.
These are really the hallmarks of a healthy, well-managed business.
Yeah.
That fundamental strength is incredibly important and supports the rating.
And you can't ignore those powerful tailwinds in the industry either, right? The CTV and retail media.
Precisely. That's the other big positive. They're strategically positioned right in the middle of these high-growth areas. Connected TV, retail media. And these aren't just, fleeting trends. They feel like secular shifts in how advertising dollars are going to be spent long-term.
Okay, so strong fundamentals, good positioning. Why not an 8 or 9 then? What holds it back?
Well, the rating isn't higher because we have to acknowledge the very real risks that are present.
The ones we just discussed.
Yeah, the high stock-based compensation and potential dilution, the ongoing litigation risk, and that growth in expenses, which watching those definitely temper the potential upside somewhat.
Yep.
They represent persistent challenges that the company absolutely has to navigate successfully.
And how does the technical picture we talked about factor into that 7-10 rating?
Well, from that technical perspective, the setup right now is kind of neutral to maybe moderately bullish if, and it's important if that 50 to 51-1 support range holds firm in the near term.
Ah, back to the support level?
Yeah. If it does hold, it suggests that maybe the recent sharp sell-off was potentially overdone and a floor could be establishing itself for future potential growth. But if it breaks, the picture darkens short term.
Okay, so given everything, the 7-10 rating, the fundamentals, the risks, the technicals, what investment horizon makes the most sense for the trade desk right now? Is this something you look at for a quick trade, or is it more of a long-term hold?
Based on everything we've discussed, this really appears to be better suited for a long-term investment horizon.
Long-term, why?
Its robust fundamentals, that debt-free status, the strong cash flow, and those powerful secular industry trends in CTV and retail media. They align almost perfectly with a strategy focused on patient, long-term growth.
Makes sense. And for short-term traders?
For short-term trading, the current picture is less clear. The choppy price action recently, that kind of post-earnings drift we saw, it creates a somewhat limited risk-reward scenario right now. At least until some new, clearer catalysts emerge, like perhaps that next earnings report giving a definitive signal.
Okay, so summing that up, the trade desk seems like a fundamentally strong company, definitely operating in a dynamic and growing market. That part's clear.
Yeah, the core story is strong.
However, the short-term noise, especially around that Q2 earnings miss and the ongoing competitive pressures from the tech giants like Amazon, it definitely creates volatility.
Absolutely.
And that volatility needs to be considered based on your own individual investment horizon and risk tolerance.
Couldn't agree more.
But for those maybe with a longer view, looking out a few years, the core business still seems compelling.
That sums it up really well, I think. For the long-term, growth-oriented investor, the trade desk offers a pretty compelling case, especially with its strong financial health and that prime position in booming ad tech sectors like CTV and retail media.
Right.
But, as we've laid out, the journey isn't likely to be without its bumps. We've seen that clearly from the recent market reactions, and the immediate future outlook has some key hurdles, like that next earnings report.
Definitely. So as we wrap up this insightful conversation, maybe let's leave our listeners with a final provocative thought to mull over.
Okay, sounds good.
Consider this. As this whole digital advertising landscape continues to evolve, and it's evolving fast, heavily influenced by things like AI and ever-tightening privacy regulations,
Yeah, big shifts.
how might the trade desk's independent and transparent platform become an even more critical differentiator in the years to come? Could that neutrality actually become its superpower in an increasingly fragmented and complex world?
Ooh, that's a powerful question. Really gets to the heart of their long-term strategic value proposition, doesn't it? Their independence in a walled garden world.
Something to think about. Well, thank you for joining us for this really thorough look at the trade desk.
My pleasure. Always interesting to dig in.
We really hope it's given all of you listening a clearer picture of the opportunities and also the challenges that this company faces right now.
Hope it was helpful.
And please don't forget to subscribe, like, and drop a comment below. We genuinely love hearing your thoughts, and especially your suggestions for companies you'd like us to look into next time.
Yeah, let us know.
Until then, happy investing.